Okay, so let's see. I thought I would try to get, I don't know if it's going to be friendly with me. So this Oanda, which I don't know really what it is, there's one site that captures a lot of live currency trading. And let's see if we can find. I don't have an account. So here's the euro to the US dollar. There we go. This is what I wanted. Okay. So some of you are familiar with the candlesticks. So that is against the euro. And we've got it trading. Sometimes it's a little weird with what we have here on the notation. So is 1.21 the price of the euro or the price of the dollar?
Price of the euro.
Price of the euro. Why do you say that? How many euros can buy a dollar?
I would say dollar to euro. So that's 121 to get 1 euro.
So we're saying 1.21 euros equals $1.
Other way around. Other way around.
So 1 euro equals $1.21.
Yes.
Yeah, that one.
Okay. So let's look at another one here. Here's the Japanese yen. So it says 105. So again, is that 105 yen? I don't know if that's the yen. I usually do that, but I don't know if that's true. Equals $1, or is it like we did up here, 1 yen equals $105?
So the 105.
Well, in this one it says
under 1, right?
Well, on this one it says US dollars to Japan. So it would have to be the 105 yen to $1. In the other state it was euro to US dollars.
So how many dollars per Japanese yen?
Yes.
You remember that equation up there?
Earlier it was 1 euro to $1.
Yeah, so what I found is that the way they report this is a little bit different on these sites than the way it actually works. That's why I'm bringing this up. So this is correct. And so 105 yen per dollar. So if we think about the exchange rate in terms of dollar, the exchange rate for the United States is 105 yen per dollar, if we were to write it in our notation. So it's a little bit goofy. I've seen that before, and that's part of the reason I wanted to bring it up. Let's see, what's going on with this candlestick here? So what is this guy saying here? This candlestick, this red candlestick, says February 21st at 2200. The next one says February 22nd at 2200. 2200 February 18th. So what is this candlestick right here saying for Japanese yen? So the height of the candlestick, if we kind of do a little diagram here, what's this thing showing?
The high.
So the high.
The bottom would be the close. The low. Yeah,
the low. Top of the box is what?
Open.
The open.
Close.
And this is the close. How do you know that?
Because it's red.
Which one's the open and which one's the close?
It's red.
Because it's red. So it closed down. So here, which one's the open? The bottom of the box or the top? The bottom. So that's what this candlestick thing diagram does. So each trading day, you can kind of look at how much volatility there was, how much movement there was in the currency, and then when it opened, when it closed, did it open or close down? And so that's kind of a nice way to look at the amount over time. Here it is over a month. And then you can kind of look at the time frames, December 31st, January 31st. So since we did, let's see, is that correct? February 29th. Oh, this is in monthly analysis back to January of 18. So over time, has the dollar appreciated or depreciated against the yen? So we were back in January of 18. Even in this trading cycle here, we were somewhere at 110 maybe level. So is that dollar appreciation or depreciation?
Depreciation.
Depreciation. So the dollar used to buy 110 yen, and now it's buying 105 as of the close. So you're not getting as much yen per dollar, so there's been dollar depreciation. Okay, so I thought I'd introduce the candlestick thing. It's kind of fun to look at. You can see that on other currencies too, and just kind of flip back and forth. And of course, there's lots of sites that do it, but this is one that I found is pretty easy to work with. All right, so now let's talk about fluctuations in the exchange rates. A little supply and demand today. Fun times. I'm going to start off with kind of working a little bit backwards from what your textbook is doing. So the textbook dives into long-term changes with the exchange rate, and then they go to short-term changes in the exchange rate. And basically, most of the long-term stuff is the short-term stuff. So I kind of want to hit you with the things that are going to make the market move first, and then we can work back to looking at the ones that would be more long-term. All right, so this author is a little different than what we did in macro class. I think in some ways it's easier. So the market for currency, we're going to be measuring dollars down here, and then the exchange rate up here. So the exchange rate is always the amount of foreign currency is up top. So if we go back to the yen per dollar, then we have a demand curve that we're just going to arbitrarily put somewhere. And the supply curve is what's unique for this book. So your author takes this approach and just says that the quantity of dollars available in foreign exchange is going to be vertical and basically fixed at a given point in time. Because we're thinking about short-term fluctuations in the exchange rate. If you remember back to macro, which I'm sure you guys all have a crystal clear memory of, I did it this way, that we did, and it's because the author did it this way. Supply and demand for currency looked like this, where we had an upward sloping supply curve. And ultimately, when you go through the things that move the currency, what affects supply also affects demand. So it's like if you're holding currency, then you want to do the same behavior of people that don't have the currency, right? So the supply of dollars to the market and the demand for dollars kind of move in the same direction. So this isn't a bad approach the way the author presents it, and just saying, let's just assume that the supply is fixed, and then we'll work through the things that move demand. And ultimately, really what moves demand is what moves supply anyway. So it's a little bit of a simplifying assumption that I think is an okey-doke thing to do. So, so we get some equilibrium interest rate. Let's just say 105. And let's put here demand shifters. Demand shifters. So number one is the interest rate differential, but I'm going to do it a little bit differently than the author that I think is a little bit easier and it should be the same. So let's just put interest rate differential. All right, so we have we're going to look at the domestic interest rate. So we're talking about the United States, for example, USA, versus the foreign interest rate. So example, Japan. And we're going to be calling these, I guess I should have squeezed in a little notation. So interest rate for the domestic United States is going to be I, and for Japan, it's going to be I star, which just simply means the foreign country. So the star is the same notation I gave you earlier. The asterisk just is an easy way to put the foreign country. Okay, so the reason this is nice is that the differential, the interest rate differential, is the difference between American rates and foreign rates. That's the interest rate differential. All right, so now we can do some changes here. If there's an increase in the US interest rate, what happens to the interest rate differential holding the foreign? It goes up. If there's an increase in the foreign interest rate, what happens? It goes down, the difference goes down. Or if goes down, the overall expression goes up, right? So you're kind of following the minus sign here on whether it goes up or down, which is kind of nice. And so if there's an increase in the interest rate on domestic financial assets relative to foreign financial assets, what happens to the demand for dollars? Does it go up or down if American financial assets are paying a higher rate of return compared to foreign financial assets? What's going to happen? It goes up because people want to buy American assets now. In order to buy American assets, you need American money. And so that's going to increase the demand for American dollars. What's going to happen to exchange rates then? If American interest rates go up, what's the impact on exchange rates that you predict? Appreciation or depreciation?
Appreciation.
Appreciation. So now we're back to using this. If this is D1, if we have D2, then the exchange rate will go up from E1 to E2, and maybe it's to 110, like we saw with the Japanese data. Moving from point A to B would be some sort of appreciation. Okay, so an increase in this leads to an increase in demand for dollars in the exchange market, which then means there's going to be appreciation of the dollar. Now I'm going to put that into words so that as you guys see some of this either in problems or the textbook, we can kind of think about it a little bit differently. So the up arrow here, this means when American financial assets are relatively more profitable, I guess. Turn that into rate of return. When American financial assets are relatively more profitable, investors around the world want to buy them. And they need American dollars to do it, to buy them. So by looking at it through the difference here, then you kind of get things right away with the foreign interest rates. If those become higher, then the expression changes the opposite direction. Okay, questions on that? Does that make sense? So American financial assets, if you wanted to highlight one more thing, you can just say that these are dollar-denominated assets. Dollar-denominated. So to buy a U.S. government bond, you need dollars to do it. Okay. So that knocks out the first two that the textbook basically puts it as domestic interest rate, foreign interest rate. And so we're kind of covering that by thinking of it that way. You'll be all set. Let's jump down. I'm going to take them a little bit out of the textbook order too, because I think it's a little easier to understand. So expected export demand. Expected export demand. So if there's an increase in export demand, and this is the expected export demand, so we put a little superscript E up here. So there's an increase in expected export demand. What's going to happen to exchange rates? So people are, with this one, you can kind of think that we're exporting more. So the United States is exporting more.
The demand would go.
Demand's going to go up. They need dollars to buy American goods. So now we're focused more on the products when we talk about exports. This is the financial markets. This is thinking about actual physical goods. So an increase in export demand leads to an increase in the demand for currency, which leads to an increase in the exchange rate appreciation. And the idea here is that to buy American goods, foreigners need American dollars. Okay, so now import. I almost wanted to kind of combine these two, but I decided to just keep this separate too, because you can do a similar thing with exports minus imports for this. Expected import demand. So we're talking Americans now again. If there's an increase in import demand, what's that going to do?
The decrease.
Decrease demand. So it's, you kind of, your gut feeling's telling you that it would be opposite of that one, right? The intuition is a little bit weird though, I think. So we're going to be demanding more imports.
Foreign goods.
So that's foreign goods.
So we're gonna demand more of their currency.
So we're going to demand more of their
Increase the
currency.
depreciation of our currency.
Okay, so in terms of the demand going on here, the bucket is tilting the opposite direction, right? Instead of us increasing for our exports, it's going to move the other direction, but it's really a little bit different. It's for this one, I think I like doing thinking almost of the supply. So if we have expected import demand, are we going to be supplying more dollars to the foreign exchange market, to the Forex market, or pulling them back?
Looking back.
So we're going to be buying more from other countries. In order to buy more from other countries, do we need yen? Do we need euros? Yes. So the supply would actually be going this direction. If we were doing supplies, which we're not, so maybe I shouldn't even brought this up and confuse you guys. But that's kind of the way my brain thinks about it, is that we'd be bringing more to the market, which is still going the right direction. We're going to get the depreciation. Or you can think of it as less demand going, is the way this author's doing it. So you can kind of tell both sides of the story, depending on how it is. So whatever works for your brain is fine, or you can just point blank memorize it. But this is a decrease in demand, which leads to depreciation. If we think about our cigarettes, way back to, this might be a good test for you guys here. So GDP, expenditure approach, cigarettes is equal to C plus I plus G plus X, which is actually net exports. Exports minus imports. And so that's where this one kind of kicks in too, is if this differential changes, if I would have done it that way, so an increase in our exports, they need more dollars, which if we think about it this way, then this equation's going up. So if there's an increase in imports, this equation's actually going down. So the net effect is depreciation. So I don't know if that helps you or hurts you, but I guess I'll throw the note in, or you guys don't write it in your notes if you don't like it. So I'll just put note. Net exports equals exports minus imports. And so you can think of this up arrow, down arrow working that way too. So the differential works, or exchange shifts too. And that's kind of similar to what I did with the first sheet. Okay, any questions on that? What are we up to? Number 4. Number 4, we're going to go back up to expected domestic price level. So the U.S. price level. This one, there should be a differential too. So prices go up. We kind of left off last time with this, with the exchange rate. So I might just throw in a little recall. We can think about this. We can kind of reason this one out a couple different ways. But our real exchange rate, so our exchange rate is equal to our real exchange rate times the ratio of the price levels. And so if you kind of have that equation down, then this one becomes pretty easy. If the price level goes up, if the expected price level goes up, an increase in the expected price level leads to what with this equation? Down. It's going to go down. Just watching the denominator here. If the denominator gets bigger, the overall expression gets smaller. So that's going to push the exchange rate down. So down with the exchange rate. And then from the way the textbook describes it, you can also think about this being with what's happening to the real rates of return. So let's recall, again, Irving Fisher, the Fisher equation. What's that? Fisher formula. Recall Fisher formula. You guys are going to kick yourself once you hear it again. Somebody's going to get it, though.
Oh, that's the interest one.
The interest formula. Yep. I equals
Real plus inflation.
real plus inflation. All right, so now we can kind of play with that with this one. So if we think about it in terms of the real rate, the real expected rate domestically is equal to the interest rate domestically minus the expected inflation rate. So that is the rate that we can negotiate today. And so if we have higher expected inflation, which is what we're saying here, domestic price level being the rate of change there. So if there's an increase in the expected price level, that means also an increase in the inflation rate expected. Those kind of go one and the same, right? That's how the inflation rate is calculated as the rate of change of the price level. So those go hand in hand. And so the Fisher formula tells us what happens to real rates then. Using this equation, if inflation rate is expected to go up, what's going to happen to real rates? They're going to go down. Now, if we're talking about our friends overseas, down south or around the globe, if the real rate of return on American financial assets, back to this equation, except now we're bringing in inflation. These were nominal rates. Now we're really talking about inflation. They do this calculation. So if the real rate of return on dollar-denominated financial assets is going down, do they want to buy them? No. No, right? The rate of return is going down. The real rate of return is going down, and so they're not going to buy them, and so the demand curve shifts down and causes depreciation. So if this happens, that would lead to a decrease in the demand for currency and a decrease in the exchange rate. So I'll write that one out again so we have kind of this explanation. If real rates of return, if real rates fall, then foreigners won't buy as much American financial assets. That's kind of the quick Russ McCullough explanation of what all those up-downs arrows did. So let me repeat it because I know some of you are blocked from view. You can feel free to stand up if you want. If real rates fall, then foreigners won't buy as much. Then foreigners won't buy as much American financial assets. If real rates fall, then foreigners won't buy as much American financial assets. Okay, any questions on that one? All right, so what else we got going on in the world? Trade barriers. Let me leave that up. Trade barriers. I haven't really heard much of what Biden wants to do with some of the dust that Trump kicked up with trade barriers, so that'll be interesting to see where that plays out. So number 5, expected trade barriers. So an increase in trade barriers expected, all these TBEs here. What do you call TBE? Trade barriers. So,
Oh, you don't have a key to the mechanic.
I don't. Well, he must be an outside contractor or something like. Because they said, well, might want to call our maintenance department instead of the economics professor. But, okay, so expected trade barriers. So Trump says we're going to raise tariffs on you, China, right? What's going to happen to currencies? Appreciation or depreciation of the American dollar in the forex market? Depreciation. It'll be weaker because we're raising barriers. There's going to be less trade or something. Yeah.
No, it would appreciate because theirs would be weaker because it would take more of their product.
Okay, so that's one way to look at it. What happened to their price is what I think you're doing, Bryce, right?
So it would cost more for them to get their products into the US.
Okay. So yeah, that one's a little bit tougher. You can look at it a couple different ways. With this book doesn't go into with tariffs. You can have a large country case and a small country case. Basically, a little tiny island country like the Bahamas, if they put up tariffs, it doesn't really affect international trade in terms of exchange rates very much. If big old Americans put on a tariff, we're the large country, we're a big buyer. You can think of it like we represent a lot of the international trade, then that's going to disrupt part of the exchange rate system. And part of that tariff can be passed along to other countries in the large country case. So if it makes it more expensive, they're not going to want to buy our goods. They can go buy from Germany or buy from somebody else. So we jack up our prices effectively with the tariff, and they're not going to buy as many American goods. So that's the tariff effect is going to ultimately be a decrease in demand, is what you think it is. So let's write that out here. If trade barriers are put into place, foreigners get less at the border. What happens to domestic prices? What happens to domestic prices? In the United States, they're going to go up. So American steel, for instance, that's part of the reason Trump was messing around with steel. Like, China's being unfair with steel, and let's tariff the steel industry so that we can raise the price in the country. So if we look at a little supply and demand in the actual traded goods. So this is imports, exports. So I'm throwing a little bit of a curveball here. We're not talking about dollars. I'm measuring the actual goods of what a tariff does. The tariff or the tax, remember our little box here? Tariff, which looks like a tax. I'll just put tax. Same effect, is going to drive up American prices. So we started here, and now the price with the tariff, let's just say it was $1, and now the price with the tariff is $1.50. So prices are more expensive, and so we have higher priced goods for one and not the other. All right, so we have dollar. So I think with this one, it's better to think of the decrease in demand for foreign currency. So if we think about yen and yen per dollar, of what's happening to our neighbors. Let me let you guys catch up here a little bit. Let's get something like this going. So for the yen, is there going to be increase in demand or a decrease in demand when we think of yen? And I'm sorry, I actually screwed this up. I didn't mean to throw an upward sloping supply curve. That was my old notes. All right.
Increase.
So increase in demand. So we're going to have yen appreciation. So an increase in demand would be, if we look at E1, that would be E2. So this would be yen appreciation. If it went that way. If it went this way, E3, we'd have yen depreciation. If we have yen depreciation, American dollar has appreciated. All right, so with the large country case, we end up getting a decrease or an increase in demand and dollar appreciation. So dollar appreciation, it's going to look like this picture with the increase in demand for the currency. All right, I feel like that just went over like a lead balloon. Let's